In today's video, I'm going to walk through and explain what I believe is one of the most important tools in retirement tax planning. This is a tool that we use every day with clients, and without it, your year-to-year tax planning will be far less effective and much more difficult. The tool I want to talk about today is the marginal tax graph. This chart on an annual basis, combined with a forward-looking tax plan, is really the core of what you need in tax planning for retirement. Now, if you've seen some of our videos before, you've probably seen me share graphs like this. Maybe you've had questions about what exactly this is or how you can get your hands on this type of graph for your situation. Well, in this video, I want to really break this tool down and show why it's so valuable for your ongoing tax planning. Now, as we walk through this presentation, reading this graph is fairly straightforward. On the y-axis, you will see percentage values. This denotes the marginal rate you are paying on a given level of income. Marginal rate is a tax rate specific to an amount of income. For instance, if you have $1,000 worth of income at the very top of the 22% tax bracket, your marginal tax rate on that income is 22%. If you withdraw another $1,000 worth of income and it pushes you into the 24% bracket, your marginal rate on that next $1,000 is 24%. The x-axis then shows ordinary income that you would be withdrawing. So if this was your situation and you withdrew $30,000 worth of income from your IRA, you would be paying a marginal rate of 29.5% on the most recent income you withdrew. Before that, you would have paid 52.4% on a portion, 24.7% on a portion, and so on. There are a lot of hurdles you will face in retirement that need to be accounted for effective tax planning. As you are deciding where to pull your income from, you absolutely need to know the tax consequences you are forcing yourself into. And so let's dive into this a bit more. Here's how most retirees envision the tax brackets. And as you can see, the brackets are pretty simple. Pull up any tax table on the internet and you will see tax brackets at 10%, 12%, 22%, and so on. Now these tax rates are simple. What complicates things for retirees is how certain income streams like Social Security are taxed, or how having some capital gain income and some IRA income can transform this tax bracket. So this shows a very simplified look at the tax consequences of having ordinary income. But keep in mind there are two tax charts that we will need to continually focus on in retirement. If you pull income from your IRA, it will be ordinary income. But if you sell assets in your taxable account to live on, or you live on dividends, those will be taxed at capital gain rates. So here's a simplified chart showing the tax consequences of taking capital gain income. We need to keep in mind both of these charts when making our withdrawal decisions because as you can see, we have different tax consequences between these two accounts. So now let's start with our first and most common income stream that complicates this tax chart, Social Security. On the screen, I'm showing a single retiree with $32,000 of Social Security benefits. You'll notice here that the tax brackets change from 10%, 12%, and 22% to 15%, 18.5%, 22.2%, and 40.7% before finally dropping back down to 22%. Well, how is this possible? To understand this graph, we need to understand how Social Security is taxed. There are two steps in determining how much of your benefit will actually be taxed. The first step is finding your provisional income. Then the second step involves plugging this provisional income into this table below. Now let's walk through an example here because there are some common mistakes that I see when retirees are figuring out exactly how much of their Social Security benefit will be taxed. Let's say we are looking at this chart and this retiree decides they need to pull $30,000 worth of IRA income to live on in addition to Social Security. You will see they're in the 22.2% marginal bracket when pulling the last $8,000 or so of this income. Well, how do we get to a 22.2% rate? Well, going back to the provisional income equation, we would have $30,000 of income from our IRA withdrawals. Since our Social Security benefit in this example is $32,000, taking 50% of this would be $16,000 for a total of $46,000. To be clear, tax-exempt income refers to muni bond interest, which we do not have in this example. So we're going to take this $46,000 number and plug it into the table below. We're using a single filer here. Now, a mistake that some make is assuming this table is like a tax cliff, meaning $46,000 of provisional income is larger than the $34,000 threshold in the table, so just 85% of this person's benefit is taxed. That's not how Social Security taxation works. It's a sliding scale. The table is calculated on a pro rata basis. For instance, since our provisional income is above that top threshold, we have full taxability in the 50% range in this table. Because there's $9,000 in this range, we would take $9,000 and multiply it by 50% for $4,500. Then $46,000 is $12,000 above the top $34,000 threshold, so we would take $12,000 and multiply it by 85%. Adding these two zones together, and we would find what your taxable Social Security benefit is, which in this example is $14,700. Now pause the video momentarily and you'll see how we arrived at these numbers. We then want to take this taxable Social Security benefit, add it into our other income, then plug it into the US tax tables. Following the calculation on the screen, you will see our taxable income after the standard deduction comes to $28,150. Now this would put the single filer in the 12% bracket, and this might make you scratch your head a bit. How do we get from a 12% bracket to a 22.2% marginal rate? Well, you can really only understand this by increasing that IRA withdrawal by $1,000 more. If we do this, we basically need to rerun all of the calculations we just ran. Now, for the sake of time, I'm not going to go step by step through these calculations, but I would urge you to, as it will help you increase your understanding. I'll just give you the explanation high level. If we increase IRA withdrawals by $1,000, we're going to increase that provisional income number by $1,000, which in turn makes another $850 of Social Security taxable. Running through this calculation further, we can see that even though we just added $1,000 of extra income, we actually forced $1,850 of extra taxable income. At 12%, that ends up with us owing $222 of taxes. But again, we owe $222 of taxes because of just $1,000 of extra income, leading to a marginal tax rate of 22.2%. As you keep stepping through this scale, this is how you reach this high marginal tax through this purple area on the screen. It stops when Social Security becomes fully taxable at 85%, but through this area, you're going to see your marginal tax rate rise by 50 to 85% because of this double taxation effect. And so as we start to look at a marginal tax graph for the year, the first step in creating this graph is to start with what you believe your expected income for the year will be. For instance, at the beginning of the year, we know exactly what we're going to receive from Social Security, pension and annuity income. We're going to know what our forced withdrawals like required minimum distributions would be, and more. Then we have a pretty good idea of what dividends, wages, and rental income will be based on some other simple estimates. The reason I want to preload this tax graph is because I want to know what the tax implications will be of the decisions that we're able to make. For instance, we don't choose to have $32,000 of Social Security benefits, but we do choose what we take from our IRAs. I want to know if we take $20,000 from our IRAs versus our taxable account versus our Roth account, what the tax consequences actually are. Let's take a look at another simpler hurdle that trips up a lot of retirees. This is called the capital gain bump zone. Now we're going to take Social Security out of the equation for simplicity here and instead add in $20,000 of expected dividends throughout the year. These are qualified dividends, by the way. Once again, we see two marginal tax spikes on the graph, but what is causing this? Obviously, it has something to do with the dividends, as we're adding dividends in this example for a specific reason. Well, let's look at the tax brackets here for a little extra insight. On the left-hand side of the table, you will notice the ordinary income rates we've already discussed. To the right of this, however, you will notice that there are long-term capital gains that span from anywhere from a 0% tax rate all the way up to 23.8%. It is the interplay between these two tax systems that creates this spike. Notice the long-term capital gains have a lower rate in every category of income versus ordinary income taxation. But there is a really important thing to note here. Capital gains stack on top of ordinary income. And so what can happen here is at a specific level of ordinary income, you might be taxed at 0% on your dividends. But as you increase that ordinary income base, you push up the taxation of those dividends. Here's a visual representation of what I mean. On the left-hand side of the screen, this person is not subject to this capital gain bump zone. Their dividends fit perfectly in a way where this person is able to maintain 0% taxability. But let's say they add another $5,000 of ordinary income, thus increasing that base. By increasing this base, you overflow capital gains or dividends into the next bracket. Okay, so you might understand this conceptually, but why does this create an increase zone? Well, let's say you have $5,000 of ordinary income displacing $5,000 of dividends into the next capital gains bracket. What is exactly happening here? Well, on that $5,000 of ordinary income, you will owe a 12% tax rate. But that's not all. You will also have $5,000 of dividends that went from being taxed at 0% up to 15%, triggered by that $5,000 of ordinary income. So 12% plus 15% would mean your marginal rate rises in this instance to 27%, just all from that $5,000 extraordinary income withdrawal. Then the third and final tax hurdle that I had on the original tax graph we showed were signified by the dotted lines. These dotted lines signify Medicare increases, also known as IRMA. When you show a certain level of income, you will be penalized and owe more for your Medicare expenses. Now, know that IRMA is something we call a tax cliff, which is why it's shown as a dotted line and not as a marginal increase here. A tax cliff means it doesn't matter if you're $1 over a threshold or $10,000 over. You have the same one-time cost. So if you show this as a marginal tax hike, it would mess up the scale of the graph because $1 of income forces a $1,050 penalty. That would make this graph look really wonky. Nonetheless, knowing where these zones are and avoiding them or pushing through them is extremely important. The last thing you want is to be $50 over a threshold zone, and then you owe an extra $1,500 in Medicare costs for just that extra $50 of income. And so now to zoom back out and look at all of these tax issues together, we can see the more complex tax graph that we started this presentation out with. We have now added in Arizona state income tax here as well. What you'll notice that's quite interesting is how these tax hurdles can stack on one another. You'll notice the Social Security taxation zone coordinate with the capital gain bump zone to create a new 50+% marginal rate zone. Then about $25,000 after these increased zones, you see you have to start dealing with Medicare increases. For retirees, this can be a tax minefield at times. Well, this is exactly why this type of graph is so important. Crossing a minefield becomes a whole lot easier when you have a map of where the mines are located. Now, one thing to mention here is I'm not giving any hard rules when navigating these tax hurdles. Some retirees may need to push through these high tax zones because there are worse tax issues lying down the road and they need to be doing things like Roth converting. Other retirees may have the ability to avoid all of these zones altogether. This is where the context around your situation is extremely important. Also, as I mentioned earlier, there are two tax graphs that we need to consistently keep in mind. Here's the same situation, but shown if they start filling in with capital gain income rather than ordinary income. Again, the graph looks completely different, and each dollar of ordinary income or capital gain income will change the starting point and shift these graphs slightly. So finding the best spot to end up is an iterative process. Now, from time to time, I have people comment saying that this is the wrong way to look at tax planning, that showing a marginal graph makes things look a lot scarier. Some say I should be using total tax or effective tax rate instead. I wholeheartedly disagree, and I don't know any tax strategists who would agree. Here's a graph showing the total tax you would owe at various levels of ordinary income. It's the exact same situation that we've been working through throughout this presentation. Now, imagine I never showed you any of the marginal graphs up to this point. Tell me by looking at this graph how you would make any reasonable or strategic decisions. You couldn't, because this type of graph is simply a summary graph with no decision-making power. Now, the next question many will have is how can I get this type of marginal tax graph custom to my situation? Unfortunately, I don't know of too many softwares that allow for this, and for the average person, doing this by hand is incredibly difficult. Our staff here uses a software called Holistaplan, and they do a fantastic job. Unfortunately, I believe this software is only for advisors. Your accountant may have a similar tool, and I would start by asking them if they can generate this type of graph for you. As of right now, I don't believe TurboTax has this ability or this feature. However, I urge everyone to find and work with an advisor or accountant that has the ability to create this type of graph, because you can see how powerful it can be in making strategic decisions on an annual basis. As you can see, there are major savings to be had. Every dollar in taxes saved does not just mean you save a dollar, but rather you save what that dollar can turn into through compounding growth. If you'd like to learn more about tax planning for retirement, here's a video that might surprise you. In this video, I talk about why you shouldn't have the goal of having a tax-free retirement. Click here to learn more, and always remember, you don't need more money, you need a better plan. We look forward to seeing you in the next video.